Good afternoon to all, while some are still trying to find their seats. It's a great pleasure to have you all here back to this afternoon session of the 2026 edition of the European Commission ECB Conference on European Financial Integration. I will, in a minute, of course, present my very distinguished panelists here, but I don't want to open this session without reminding all of you of something I've just learned, and that is that Ignazio Angeloni was the one who thought of this conference, I should say maybe some decades ago already, but you can expand on that if you want to later.
I don't want to confess that, but...
Don't confess.
Yeah.
So this annual gathering has become a trusted space for open, constructive dialogue among policymakers, supervisors, industry leaders, academics, and civil society. And I'm delighted to see that that spirit of collaboration is alive and well today. Now, our panel addresses a question that is central to Europeans' long-term prosperity. How can a more integrated banking sector enhance the competitiveness of the EU economy? And this is not just a technical question. It is a strategic one, touching on Europe's ability to finance innovation, to support the green and digital transitions, and compete globally in an increasingly fragmented world. In the Eurosystem response to the EU Commission's targeted consultation on the competitiveness of the EU banking sector, it's a mouthful, published last month, we emphasized three messages that are highly relevant, I think, for today's discussion. First, Europe's financial and regulatory fragmentation continues to constrain the competitiveness of our banks. As the report notes, the continued fragmentation of EU banking markets acts as a brake on European banks scaling up, realizing economies of scale and competing both within and outside the EU. Completing the banking union and removing barriers to free flow of capital and liquidity remain essential steps. Second, the resilience of the euro area banks is a prerequisite for sustainable growth and competitiveness. The report highlights that banks today are significantly better capitalized, hold higher levels of liquidity, and adhere to more robust internal governance and risk management frameworks compared to a decade ago. And this resilience is no luxury. It is the foundation for supporting investment and absorbing shocks. Third, undue complexity in the regulatory framework must be addressed. As the document states, undue complexity in regulatory frameworks should be tackled while maintaining a level playing field to ensure fair competition while supporting innovation and containing risks. Simplification without lowering prudential standards can help banks operate more efficiently and compete more effectively. And these themes will guide our conversation today, which is structured in 3 rounds, each designed to build on the previous one and move us from diagnosis to strategy to action. So in the first round, we will take stock. We will take stock of where we stand. How competitive is the EU banking sector today, both within the single market and globally? And what are the main obstacles that continue to hold us back? This is our opportunity to set the scene and identify the strategic challenges ahead. And then after the first round comes the second round. And in the second round, we will explore the broader economic implications. Would a more integrated and more competitive EU banking sector strengthen the competitiveness of the EU economy? And here we will bring together political, industry, investor, and institutional perspectives, looking at financial conditions, cost of capital, market depth, risk sharing, and Europe's long-term investment needs. And in the third and final round, we will turn to concrete proposals. What should be done? What should be done realistically and pragmatically to achieve a more integrated and more competitive EU banking sector? What are the priorities, the trade-offs, and the actionable steps that the European Commission could, maybe should consider as it shapes the future of the single market in banking? Or I should maybe say one market, I've learned today. To help us navigate these questions, we are fortunate to have an exceptional panel. Jonás Fernández Álvarez, member of the European Parliament and a long-standing voice on economic and monetary affairs. María Abascal, Director General of the Spanish Banking Association and the Chair of the EBF Executive Committee, bringing the industry's operational and strategic perspective. Britta Schmidt, a Senior EU Banks Analyst at Autonomous Research, offering the investor and market viewpoint. And last but not least, Ignazio Angeloni, a Senior Policy Fellow at SAFE and a leading thinker, and very well known in this house, of course, on the structural and institutional dimensions of European financial integration. So thank you all for having made the time to come here, and all of you, and also those online. And by the way, I am instructed to also say that there are possibilities in Slido to come up with questions, etc. So at the end, I will try to make sure that we can have interaction with those in the audience, both here physically and online. So you can start thinking about your questions right now. So first round. I would like to invite each of you to share your assessment of the current state of EU banking sector integration and competitiveness, both within the single market and globally. And important, what you see as the main obstacles that continue to hinder deeper integration. And maybe, Jonás, I can start with you.
Okay, now first, thank you so much for the invitation. Good afternoon, everyone. It's a pleasure to be here to talk on this matter. And I have to say that, no, after what you said, Frank, I have nothing to add. Yeah, to be completely honest. Yeah, Commissioner, by the way. No, I think that no, the current situation of the European banking sector is good if we compare it with another moment in the past. During the COVID crisis, we had the possibility to check the prudential framework we put in place after the financial crisis. It's true that during that crisis, public authorities put also many measures to protect people and households and business. And protect banks too at the end of the process. But in any case, I think that we tested the prudential framework, and we have to say that the European banking sector works well, and currently the profits capital ratio, there is not any kind of long constraints taking into account the ECB service on this mandate, on this issue. So honestly, I have to say that the situation is fine, even though as you also said, we face a lot of challenges. Yeah, we need to increase so much the investment in the European economy, part of the through equity, another from debt, of course, and we need to review what we can do to improve the potential growth of the European economy and what we should do concretely on banking sector. And I have to say that to fulfill this objective, the best way to increase competitiveness without water down the current prudential framework is advancing faster in the banking union, in the single market, in the saving and investment union, and this is what we should tackle. Yeah, if we read the Letta's report and Draghi report, we realize that the European Union has currently a high liability, and the liability is that the single market does not work correctly. Yeah, the ECB report analyzing the shadow tariffs, the IMF report from the previous year. So we have many elements to evaluate that we have a really problem if we want to increase competitiveness, because we don't have yet a single market. The point is that if we want to advance on this matter, If we have at the end of the year another legislative proposal as we have currently on the market infrastructure and supervisory package that the Commissioner put perfectly on the table, we need to combine different views, the position of many stakeholders, and trying to have a package to be negotiated during the next year, to promote competitiveness and growth in the European economy. Thank you.
Thank you so much. And Maria, I'll go to you.
Well, good afternoon, ladies and gentlemen, and thank you very much to the European Central Bank and especially to the Vice Chair of the Supervisory Board, Frank, for the invitation. It's a pleasure to be here in this important conference and to discuss about integration and competitiveness. So just looking to the diagnosis, I mean, I couldn't agree more on what you say, Jonás, that the European banking sector is in good shape. But this should not really give the idea that we didn't need any change. So my first comment would be on the diagnosis on integration. The cross-border banking lending in the EU has been limited so far. Only 14% of bank lending in the EU is cross-border. So this means that 86% of bank lending is relying on domestic banking sector. So, well, these are big numbers, and we can easily see how cross-border activity in different member states of the EU has been very limited, especially after 10 years of the banking union and in comparison with the size of the single market. Of course, this statement has some nuances because integration exists for certain market segments. For large corporate, we see that there is roughly 35–40% of the bank lending is cross-border. But for SMEs or households, this is almost absent with cross-border lending below 5%. We should think about this as a limitation for growth and scale-up of SMEs, because they basically, SMEs relies on domestic banking sector. So this credit fragmentation comes with a cost because capital and liquidity cannot freely flow to where they are most productive, or we have more difficulties in mobilizing strategic projects. Many times it's true that we have large companies, but below these large companies we have a lot of small SMEs that are the providers. So what are the barriers for banks? Really, in practice, European banks have a lot of difficulties because of legal and institutional barriers on offering the same products, processes, customer journeys to their clients in different countries, even if they act with a passport. So what are the barriers? I would say that first, the national gold plating on European legislation. We have different onboarding requirements that really requires local adaptation, despite having the GDPR, which is a regulation, but really there are different national interpretations that ask for these local adaptations. We have also different client consents. We have different consumer and investor protection, which makes very difficult the standardization. We have differences in insolvency regime with different creditor hierarchies. We have also divergence in the collateral and enforcement framework. So we can think that foreclosure may take months in a member state and years in another one, and this is especially relevant in the real estate domain. We have, this has been mentioned many times this morning, the absence of the European deposit insurance scheme. I mean, that's a problem for integration and reinforce the home bias. we have also, we don't have this free flow of capital and liquidity, so we lose efficiency there. And we have fragmentation in the tax schemes. So this is also mentioned this morning, the withholding tax, but also different treatment in the loan loss provision, in securitization, and also in the, in the national measures adopted with the banking. So this creates material, legal, operational, commercial, technological barriers for banks. So really we need to fix that, because this is a constraint for growth and for European strategic autonomy.
Thank you, Maria. It strikes me that the list is long and that you know the list by heart. So we have struggled with these issues for a long time now. So, but later in the conversation, I hope we also get to some perspectives how we can improve on that. But thanks a lot. Very helpful. Britta, please.
Yeah, firstly, thank you very much for inviting me to this panel. So I'm coming a little bit from the investor perspective on all of that. And everything that Maria said basically reflects in my daily job, where we discuss whether investors prefer Italian banks over Spanish banks or French banks. It's very much a discussion around borders, with the exception of just a handful of banks. And if we dial back as to how did we even get here, in the early 2000s, we've seen a big consolidation wave where there was also investment across borders, especially the EU accession trade was very much en vogue in the time, and has created larger banks. Then post the financial crisis, we've seen a retrenchment. And while we've seen a consolidation of domestic market shares within national borders, we haven't seen that going cross-border. And quite on the contrary, actually, partly due to some European Commission restructuring plans, some banks were incentivized to exit some of their investments abroad. And since then, we've seen a handful of cross-border deals, but not very large ones, I would say, but no major change in creating pan-European banks. And maybe to add to the statistics that Maria gave, and we've heard earlier about the lack of cross-border lending, if we look at the deposit market share of European banks as percentage of the Eurozone, the largest bank has a market share that hovers around 6 to 7%, and most of that comes from its own home country, versus, for example, US banks with 13% leading market share. So there is a lot of potential, clearly. And the situation that we're in basically also results in discussions of investors around these kind of country investments, partly as a result of different economic growth prospects that we see in some countries. Loan growth is faster in some countries versus others. It also impacts the cost of equity, for example, which is very different. So undiversified banks are indirectly more exposed to their home sovereign, you could say. And then there's also another fragmentation layer that has come up in the last couple of years, which is around bank taxation, for example. It's also an area of fragmentation. All of that impacts profitability and growth outlooks, and therefore impacts how investors think about banks, and very much along national lines. It's been a long time since we've written about potential upsides from a banking union. I think investors have lost a little bit of faith around that path. There are very few businesses that have gone down the branchification route, because there's still points of friction there, and we might discuss that a little bit. We are currently in a situation where even some of the domestic M&A deals are not being successfully completed. And then there's also another point from an investor point of view, that is complexity discounts. So we do have some pan-European groups, and these are largely the ones that were created in the early 2000s, not recently. And especially in times of stress, but even in better times, this issue of trapped liquidity and trapped capital very often leads to debates around efficiency in allocation, and therefore a so-called complexity discount. Other things that we often discuss, which make it difficult for us to assess the consolidation prospects going forward, is the predictability of regulation of what a combined entity would look like. MREL is complex even for a single bank, never mind for a pan-European bank, never mind for one that wants to then also merge with someone else. And there's also a bit of a buffer debate, which we're probably also going to talk about regarding harmonization of buffers, because it really matters where you are, where is your host country. very similar with the branchification idea. It matters where you are and what deposit insurance system you pay into. So I think there's still a lot to be done. There's a lot of potential, but currently our debates are very much along national lines with investors.
Thank you, Britta. I think it's already extremely rich, and we are only in the first round, and we haven't yet heard from Ignazio. So
no need for my intervention. Everything is said.
But please,
No,
the floor is yours.
Frank, thanks a lot first of all, for your words initially, very kind, and also for inviting me. I feel thrilled and a little bit emotional about being back in my old home, seeing how many friends we've worked together in the different capacities. And the thing that came while I was preparing a little bit my remarks for today, the thing that came kind of spontaneous to compare our expectations or our hopes at the time. I'm talking about particularly when the SSM was conceived, so the period between 12 and 14, when 14 was when it became operational. So our expectation then for over a 10-year horizon, more or less, where we are now, and the reality of today. And I think it's mixed. I think it's mixed. I think we need to give 2 thumbs up for the prudential side. I mean, we've not had a banking crisis. We've had banking crises in the world, but not in Europe, which is remarkable in the last 10 years or so, which is remarkable given the standards previously. The balance sheets are more or less clean by any standards that you can think of. Profitability has been restored. With a little bit of help from my friends, as they would say, from the interest rates, which were too low at the time, and now they are more or less on balance. Stock market values are rebounded, especially recently. So the prudential goal has been fulfilled, beyond any much better than the expectations at the time, I have to say. And it's natural that this should have come first, because after all, if you read the SSM regulation Article 1, it says that banks should be safe and sound. It doesn't say that the banking system should be integrated. That's an implication. That's a sort of a second step. Okay, so the point I want to make now is that we have achieved that goal. That's a necessary but not a sufficient condition. And now we need to move forward to the next step. And the next step, in my opinion, is to have a handful of banks, or maybe 2 handfuls, but not more than that, that have the size, the business model diversification, the geographical reach, the internal structures, the culture, the solidity to be leaders in the whole dimensions of banking, not only the retail banking, which is the bread and butter of our banks, but in particular the investment banking, which is crucial for growth, and I'll come back to that. And not only that, be leader in Europe and compete globally. And that, at the moment, we don't have. So when I heard Jonás saying a minute ago, the situation is fine, I know you didn't mean that. I know what you had in mind, but the situation is not fine. Now we are ready for the second step. And what does that imply? Let me mention a couple of data that I've jotted down a few days ago. So the largest US bank which operates in Europe, actually I don't need to tell you what's the largest US bank, you all know that, operating very active in Europe, is well over 2 times the largest European bank by a number of metrics. The market share of US banks combined in investment banking in Europe is greater than the market share of EU banks in investment banking, measured by total fees in all dimensions of investment banking in Europe. So even when you're talking about investment banking in Europe, the market share of the US bank is bigger than the market share of EU bank at home, in our home. The trading revenues of US banks are now more or less 3 times as big as the trading revenues of EU banks. Another thing which is maybe a little bit detailed, but I read it the other day in the Financial Times, that JP Morgan has just announced a program to finance European security and resilience, what we talk about is strategic autonomy that we have a lot of interesting comments about, apparently now is going to be financed by the Americans, in particular by that bank. That's a typical thing that the European bank should do. So put all this together, our banks are strong in the retail component, but the retail component is a utility. That's how I would consider. That does not make growth all in all. Of course, it has to work and it has to be efficient and blah, 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 and all these things. But it's key, in my opinion, that our banks are made stronger in the investment banking dimension. And for that you need, as I said a minute ago, you need size, business model, diversification, and you need geographical reach. So you need these things. Now, I have a number of comments on how this should be done, but this is, I understand this is your second round. Let me just mention one thing. When I said you need a handful or two handfuls at most. If you look at the US banking system, which we consider sort of the quintessential of an integrated banking sector, there, the real cross-nation, cross-border banks within the US territory are just a few, just not more than 10, probably less than 10. Okay, all the others are local, and they are completely irrelevant from the point of view of financial integration. So that's why my suggestion, which I've written some time ago, maybe you are aware, but which maybe we're going to discuss in the next round, is that one should focus regulation on a particular subset of banks that have the culture, the ability, the business model, the capacity, and the ambition to become cross-border. That's enough to make the system integrated. You don't need to have a regulation that makes everybody integrated, because not all banks, the vast majority of banks don't have that ambition, and they don't need to be integrated.
Well, thanks a lot, and also for building in this cliffhanger that you will come back in the second round with more of this. So this is excellent. So I think that kind of like concludes setting the stage. And just to remind all of you here of the of the order of things, we are now going to try to explore the broader economic implications. Would a more integrated and more competitive EU banking sector actually then strengthen the competitiveness of the EU economy? And I think actually the most equitable, fair way of giving all of you the floor in the same order. So I will just do that. So Jonás, here you go.
No, I think that I say that the situation is fine in comparison. Yeah, what we were some years ago. But I don't know if I have to say that on this question or in the next one. But I would like to talk about EDIs, because most of the problems that we have to tackle, the national barriers that remains in the single market, I think that all of them are in one way or another linked to the debate on EDIs. At the beginning of the banking union, I think that we had two controversial points on the table. Yeah, one of them was the prudential treatment of sovereign debt. The second one was the adaptation or the situation of the Sparkasse. Yeah, so I think that we need to recognize that this problem has been on the table from the beginning. But after many, many years without any real advance on the banking union, I think that now the most problematic point that we have is the distrust among member states, among supervisors, because now with the current framework, we have one single rule book and one single supervisor, but if there is any problem, at the end of the day, national DGS are who are behind or who have to absorb cost. Yeah. And given that, what we see is that national supervisors don't let use the capital and liquidity waivers that we already have in the regulation, even though we need to improve them. We have a real problem in the implementation of the current waivers. We have, in some cases, extra layer of capital because national supervisors don't trust others. And even though I think that the debate around EDIs is very difficult, and indeed we were not able to advance on this matter for a long time, I think that the EDIS is linked with many of the problems that we had to advance in the integration of the banking union. Yeah, and I think that, no, as I said, it's not easy, but honestly, I cannot see any other way to recover trust. And trust is needed to reorganize, for example, the supervisory framework. Yeah, when we talk about complexity, I think that part of the complexity was born from the fragmented market. Yeah, so I think that, for example, on supervision, the system is a streamline. But again, we need to analyze that debate, trying to reduce the fragmentation that we already have. Yeah, and fragmentation also comes back to the debate around EDIS. Yeah, so I think that EDIS is key. Yeah, to try to face most of the problems that we already have.
Thank you, Jonás. I saw the commissioner making notes when you said that. Maria, please.
Well, I would like to focus now on what do we need. So we need, we have been efficient in ensuring financial stability, that's for sure, and we have avoided financial turbulences in Europe when other jurisdictions had it. But we need to gain efficiency in our framework, and we also need to gain scale. So scale is essential for competitiveness and growth, which are the most important challenge we have as a region, as society. Well, especially because we have this 1.2 trillion euros of investment needs annually to invest in energy security, data centers, artificial intelligence, defense, and so on, and rebuilding industries, capabilities, and so on. So with that scale, banks would be, or that would be an enabler for banks to diversify risk across countries, across sectors. It would also help to lower or narrow the prices that we have seen over the past decades in Europe because of this fragmentation. We see in corporates the differences between the highest and the lowest interest rates were kind of 3%, 4% in normal times, and even 4-5% in stress periods. And for mortgages and households, these differences ranges from 1.5% to 2.5%, or a little bit higher in stress time. These also, if we really make progress, as also Ignazio said, in this investment banking and scale, we would be able to fully mobilize the whole balance sheet of this big European banking group, so it's easier to finance big projects. And finally, is also an important, a critical element, I would say, to invest in technology. We need to do a lot of investment in cloud, in artificial intelligence, in cyber resilience, no? And for that, the prudential treatment of software is also important. I think that diversity in business model is good, is positive, because you can serve different clients, but really Europe is lacking a big European champion in the banking sector that really helps to, well, mobilize this investment. I also want to make a comment on the role that European banks play to develop the savings and investment union, because many times this is seen as competition between banks and capital markets, and we see quite the opposite. I mean, we think that banks are critical players, and that plays a critical role for really capital markets reaching the economy in many different ways. I mean, banks are the bridge between the savings and the investment. So what we need is really to facilitate the access of different financial instruments, investment funds, bonds, long-term savings, of course, always with financial literacy, that's clear. Banks play a critical role also in helping companies to be market ready, in the sense that we start with a long-term relationship with analyzing risk, monitoring, and with facilitating the access to capital markets through equity, through issuances. And so it's important, it's more a complementing role. And finally, of course, we also play an important role in originating and distributing that risk in the market. So it's important that we go hand in hand. Banks are really ready to play this part of the solution. We think we need both this simplification and gaining efficiency in the framework, a framework that foster growth and competitiveness, and also that foster integration and facilitate the scale, eliminating these barriers, because that would be a multiplier in Europe for growth and competitiveness.
Thanks a lot, Maria. I have to say, what I like a lot when you talk about banks, then you say we. And of course, normally in this house, when we talk about banks, we say they. But it is really very good to have you here also on this panel, so to bring in that perspective. Now I go to Britta, who talks about banks as they. Yeah. But maybe you can also shed some light on how you think that a more integrated, more competitive EU banking sector strengthens competitiveness in Europe, which is the broader theme of this second round, but go ahead.
Maria has already mentioned quite a few points, but maybe to put this also into perspective, because actually there was a question this morning, slightly, obviously not related to this panel, but it was going into the direction of how can we incentivize investment when companies are pursuing shareholder payouts, let's say. And I would say we're currently in a situation where banks are well capitalized, they've got a lot of liquidity, loan-to-deposit ratios are actually rather low, I would say. At 2% rates, they are profitable. And that is a good opportunity to look at investments, and especially a lot of banks have got excess capital. And there's a certain hierarchy, I think, that a lot of management teams as well as investors share as well. The most value-generative investment that a bank can do is to grow organically at a return on equity that's above the cost of equity. Just simple example, if I make a 15% return and my cost of equity is 10%, every 1 billion invested is worth 1.5 billion. If I return that 1 billion to shareholders, it's worth 1 billion. So there's definitely a preference for growth, if we can find it. It's just meeting, demand and supply. And in the middle, there's also this M&A case. If a return on investment on M&A can make a lot of sense and is above the cost of equity, even that would be preferable to payouts in a lot of these cases. So there is an opportunity to have banks really think about how they want to deploy that sort of capital. I agree with Maria. I think banks could do more in a less fragmented banking world. There is a lot of capital that is currently meeting credit demands, I think. But banks could do more. Larger banks can invest more into digitalization, for example, and I think that's a necessity. And here we probably should stop thinking about just banks versus fintech players, but in the future it'll be more, we're all operating in one market. They can deal better with emerging risks, climate, for example. There's also structural risk around stablecoins and CBDC and also investments. Everyone wants to grab the bank deposits, basically. It looks like everyone wants to have a slice of the banking deposit base, so we also need to deal with that. We need to find exit markets for banks to distribute the risk a lot better. And to your point, we do need more investment banking businesses. And for investors, that causes always a little bit of an allergic reaction, because investment banks are seen as more volatile, they have a higher cost of equity, less reliable profits, who knows what they're doing. Of course, there's exposure to non-bank financial institutions quite often that is involved. But if this can be managed appropriately, these can be profitable businesses and businesses that we need. And I think we do see some banks that you would have typically considered to be more universal banks investing more into their CIB businesses. So from an investor perspective, questionable whether it's the greatest use of capital, but I think from from a broader kind of financial system perspective, this is really necessary. And I think we touched on it this morning as well. I mean, non-bank financial institutions will have to play a role. We really need to think about where banks would sit in a savings and investment union, on what part of the risk spectrum they sit. They have D-risks, and I think you could argue that the growth in non-bank financial institutions is also a result of the banks retrenching from riskier areas. And in the future, they will have to be part of a risk chain. But we need to think about whether we want banks, what type of risk do we want banks to take? So if we talk about financing innovation, startup capital, etc., that's perhaps more adequate for other areas of the risk spectrum. And this is, I think, where banks could really play an important role in terms of they've got the deposits, they've got the channeling of funding. We see more banks actually also investing in asset management and insurance business. They are interested in these sort of fee lines that I think are important for driving investments in Europe forward. So I think shareholders and banks would be very aligned there, but we just need to be able to meet kind of demand and supply and also find a measured pace and give banks more opportunities to invest in some of these projects.
Thanks so much, Britta. Very good. Ignazio, this whole room has been hanging on that cliff where you led us in the first round. So again, I know all of you take a little bit of liberty to go outside the scheme of these rounds, which is perfectly fine with me. But just to remind all of you, we are trying, after having to set the scene in the first round, to now talk about how a more integrated, more competitive EU banking sector can strengthen the competitiveness of the EU economy. And in the third round, we will actually then ask all of you to see what could be, the most, concrete proposals that if you really held the pen, if it was up to you, how you could change things, what would it be? But before we get there, Ignazio, the floor is yours again.
No, I think the question you are asking us in the second round is why do we need integration? What type of integration do we need? And how that impacts competitiveness of the European economy. So not so much the banking competitiveness, which is a component, but of the whole economy, right? It's a complicated thing. Results from the formal research are not always conclusive. They're sometimes a little bit ambiguous. But the way I like to think about it is there are three channels or three ways. One is the risk sharing. So the more integration you have through the financial system, there are other avenues for integration, but the financial system in particular, which is very important in the US. The more you have that, the more the local economic shocks are distributed, etc. So you reduce the local shocks. You may increase the systemic shocks. So you have to be careful about that and have a right macroprudential framework. But that's the risk distribution aspect. Then there is a second thing, which is the more competition and therefore more efficiency. So the local markets are more contested and therefore there's more competition and the efficiency of the system increase as a whole, not only locally but everywhere. And the third, which to me, by now I think not a mystery, is the most important one, is the size and scale. So the more integration you have, the more you have the possibility that local banks grow, not only locally, become cross-border banks, and then eventually down the road we will have European champions. I don't like this word, champions, but that's what they are, that's what they should be. So the risk sharing is important. It's more an issue of economic efficiency more than competition, but it may be relevant for competition as well. In order to have that, you have to have cross-border banking. So you have to have actually local banks go out and lend either directly or through subsidiaries or branches, etc. But you have to have cross-border banking activities. And we know that this is proceeding, but very, very slowly. Most of it is domestic. This is no mystery. Of the cross-border, that's pretty strange, I find. Of the cross-border lending, at least, the cross-border outside of the euro area is bigger than the cross-border inside the euro area. So there seems to be a little bit of allergy of European banks to lend cross-border within other euro area or banking union area countries. So, but you have to have, this is a process which is going on. The charts, if you look at the charts in your reports, increase, but very slowly. The second thing, the competition and efficiency, you don't actually need to have cross-border banking there for the markets to be contested. The fact that the markets are open and there is one market or a single market is sufficient to make the local markets contest. And to some extent, I think this is happening. You have nice indicators in your reports that show the price convergence of price for banking products. It goes up and down cyclically, but there is some progress there. I have seen it happening in Italy, for example. In Italy, there is a big presence of French banks through subsidiaries, which they have either set up or acquired to merger and acquisition. I think that has had a positive impact on on Italian banking. So I think that to some extent, maybe not massively, but to some extent is working. What is really missing is the size and scale component, which, as I said, is, to me, a necessary condition to have a banking sector that has certain intermediaries that have the right scale, the right dimension, the right articulation of business model to be leaders in Europe. That we still don't have, and that's what we need to work for.
Thank you so much, Ignazio. So I have to confess, last night I was frantically calculating, thinking, okay, I have 4 panelists, I have 1.5 hours, I need to have at least 15, 20 minutes for questions at the end. So where should we be after the second round? And I thought 14:47 would be perfect, and here we are. So that's excellent. So now we go to our third round, and maybe it is the most interesting one, and it is the one that we want the commissioner to be writing a lot, because this is where we are going to think about concrete proposals. Concrete proposals. What should be done? And I kind of like condition this, no, realistically and pragmatically, to achieve a more integrated and more competitive EU banking sector, so that 10 years from now, when we look back, we say, you know, it was not just that, you know, as you said so poignantly in the beginning, Ignazio, that, you know, looking back the first decade, you know, a lot was achieved, but that we can then also say, look at that second decade. So Jonás.
As I said before, I think that EDIS is key, not only for EDIS itself, but also to tackle another challenge that we have on the table, where I think that we will be in a better position to solve them with an EDIS in the banking union. My political group, by the way, published a report last week on this matter. So in that report, you can read more concrete proposals about what we should do. But maybe EDIS is critical for us. Yeah. Apart from that, as everybody said before me, we need to liberate banks to allocate capital and liquidity around the banking union. Yeah. So we already have some waivers, but national supervisors, I think that they don't like so much the use of these waivers. I think because EDIS is not there, or one of the most relevant points. We need also to review the framework for mergers and acquisitions. So currently, most of the regulations and decisions power are in member states' hands, and we saw some issues or some cases in the last few years, and it's true that we need more. Yeah, we need bigger banks, and we need to tackle that barriers. And I think that the current framework for mergers, given that most of them are in national hands, is another barrier. On macroprudential, from the macroprudential point of view, I think that we need to review again the supervisory framework. Yeah, we need to harmonize at least the macroprudential framework, and there are other issues. Yeah, gold plating, as Maria said at the beginning, the insolvency law. That this is another tricky point. No, I think that there are many proposals. Most of them are arrive on this panel. But I think if we should summarize, the point that we need is advancing faster in the banking union. Otherwise, we will not have investment banks or bigger banks, or we will not be able to provide loans to challenge that the European economy has. And we will not be able to exploit the efficiencies that now are there, but we don't exploit them.
Very clear. Thank you, Jonás. Maria.
Okay, well, that's my favorite question.
I know. So actually, I can allow you a little bit more time because we are doing well. Yeah.
No, so well, I think that the main priority and the main change is to have the focus on growth and competitiveness. I think that this is a cross-cutting demand from all the industries in Europe, transport, agriculture, pharmaceutical, cosmetic, and banks too, of course. We really very much welcome the European Commission consultation on the competitiveness of the banking sector, and also the high-level report by the ECB with measures to gain efficiency and simplify. I would like to say that the banking industry is not really asking for deregulation and dismantling all the financial architecture. What we are asking really is to gain efficiency and rethink a little bit the process. If I would have to summarize or to highlight 3 changes, first would be to have a holistic view on the capital requirements that banks are having, and also to have stability on that capital. As we have said, there are broad consensus that the European banking sector is well capitalized, of course, because we have a very robust prudential framework, but it's true that we have a very complex framework. So we have European banks needs to deal with more than 20 authorities. They work on silos. So, there are layers and layers of regulation and decisions. So our first proposal is that we simplify that framework by identifying overlappings. The macroprudential framework is also by eliminating gold plating on international standards. We remember that we have 140 RTS by the ESA, so this makes the whole regulation more difficult. So our proposal is, we should allow or introduce a mechanism to coordinate among different authorities, so they speak to each other before making their decision, because this is the way to identify if they are just touching the same bottom. So they can identify overlappings with the commitment to eliminate those overlappings. And then stability on capital. We are not asking for reducing the capital, but we think that European banks have enough capital, and that we should somehow avoid the trends we have seen over the past years of increasing continuously the capital through different mechanisms, different layers, included also supervisory discretionary decision. You know that we have this report by GARP that estimates that only over the past 4 years, this capital add-ons has increased by 100 billion euros, which means, in practical terms, lower credit to the economy in 1.5 trillion euros. So, we need to make sure that those, of course, this is macroprudential buffers, national authorities, European authorities, and different actors making decisions on a single entity. So here again, we very much welcome all the proposals to gain efficiency in the supervisory processes. For instance, to be proportional on the risk you are addressing when opening a supervisory action. We know this is a little bit the plan. Enhancing coordination between GST and horizontal teams. So really they share better information without consuming a lot of resources within the bank. that would be part of the solution, having this holistic view on the capital that we are asking to the entities. The second is to broaden the regulatory and supervisory culture, in the sense that it's true that since 2008, the focus has been on financial stability, and rightly so. I mean, financial stability should be preserved, absolutely, but what we say is to broaden and widen a little bit the focus to take into consideration also growth and competitiveness, as other jurisdictions are doing. And here again, we have received the challenge by authorities saying, well, but Europe is different, because within the SSM, the SSM is simply a supervisor and not a regulator. But practitioners, well, what they experience de facto is that this is an extra layer of regulation through guidelines, expectations, interpretations. So I mean, the idea is to broaden this focus, so they also look for growth and competitiveness as other countries, not only the UK, is doing, and also reinforcing accountability, in the sense that, well, we need also to enhance ex ante and ex post impact analysis to make sure that the decision, both regulatory or supervisory decision or measures we intend to adopt, are fit for purpose and really fulfills the policy objectives we want. Because this way we think we somehow change the culture. And also, I mean, that would be a little bit on broadening the focus. Finally, we have discussed a lot today, scale and integration. I think that's also critical. For us, is the time to complete the banking union. And this has different elements. Of course, we have the SSM, we have the SRB. Now, we think it's time to complete the third pillar, the European Deposit Insurance Scheme, but it's also the time to make sure that we have free flow of capital and liquidity within the banking union as a single jurisdiction. It's also the time to have more confidence and reassurance that we have the liquidity we need in case solvent institutions need solvency in stress time. We have that framework, but at national level, it would be good to have it at European level, as the US has. And of course, also it's important politics, because we see many times that there are different initiatives that cannot succeed because of politics. So that would be a little bit the summary. And for us, we see progress in the sense that there are political support. I mean the Council, the European Council, the Commission, the ECOFIN, they are discussing about that. But we really think it is time for political movement and not just for technical discussion, because we already have presented very detailed proposals. Thank you.
Thank you so much. Very clear. Britta.
Yeah, hard to follow, given such a list already. I think the main thing is really, if we boil it down to that, I think from a market perspective, the issue is not really regulation. We've done a lot on regulation. The question is really the political willingness. And we can talk about EDIS for a long time, and the question really is how much more capital, liquidity and resolution funding do we really need for there to be finally enough trust? Or is this more a matter of public sector deficit situations or industrial policy around the banking system that prevents this from moving forward? Because then the answer doesn't really lie, I guess, in anything that we're discussing around the prudential side. So of course, you know, a workable form of EDIS would be a dream and would be very important to create those couple of pan-European champions that we were talking about. In the absence of that, allowing large branches to operate would be a workaround, but it does require the capital waivers where we are still stuck as well. I also think that we need to think again about M&A interventions and to what extent this should be left to shareholders, or where the intervention level should really be. And recent deals have shown that this can be a very emotionally charged debate as well. So I think that really is, all of this topic of political willingness is probably a little bit more difficult to get our heads around. On the prudential side, there are areas where we see some frictions that make our life as analysts quite complicated that could potentially be addressed. So for example, the different scalings of OSII buffers, how it's treated in different countries. We've added now the banking union floor, but that's just a floor. There are still some outliers to the up there. I mentioned MREL already. I think really that perhaps it would be useful to have a review there and think about where we are, where we have the capital buffers. And I think what would also help is reducing authorization times for M&A deals. We see a big difference in Europe versus the US, for example. And then lastly, I think we haven't really talked about it all that much, but what we hear from the banks is that there are a lot of interoperability issues as well. So cross-border payments, for example, or payment systems, retail instant payments, cross-border, generating a European stablecoin, for example. I think there's probably a lot of work that we can do there as well, which might be some easy wins that could be very helpful. Yeah.
Thank you, Britta, for building on this. Ignazio, your pragmatic list.
No, I also had a clarification question or comment on Maria. Maybe you want to, the interaction you want to do later. But no, I've heard with a lot of interest and attention all the comments that have been made around the table. They are more at the margin, the more on detail aspect that can marginally be improved, as opposed to the thing that I would like to recommend, which is a little bit more radical. So, but of course, I'm mindful of the motto that says, be careful what you wish for, because it may come about. And then you are on the line. Ah, you recommended that. What a disaster. No.
Don't hold back.
2 or 3 years ago, I wrote a report, which actually was for the European Parliament, in which I recommended basically, it's a very boring, long, and complicated report, and very technical, but the substance was, okay, you want to make cross-border banking real, right? So what do you need to do? You need to eliminate all the legal impediments. It's a necessary condition. Then we have to see if the business practice of the banks actually follow up. That's another thing. But okay, supposing that the obstacles are removed, which are these obstacles? The obstacles are all the provisions which, if I remember correctly, Article 6, 7 of the CRR or thereabout, of the European regulation, which gives rise to ring fencing. So that prohibits the efficient distribution and allocation of capital resources, prudential resources, large exposures, etc., from one country to the next, which are largely, if I remember correctly, I'm not a legal expert, but they are actually in large part inherited from previous regulation, previous legal bodies which were there and have remained more or less intact after the CRR-CRD construct has been put in place in 2011 or 12. So remove those. At that point, you are in a risky situation. Why? Because the location of the risks, the geographical location of the risks, may no longer correspond with the geographical allocation or positioning of the buffers, of the prudential buffers. So what do you need to do? You need to make sure that as ex ante there is freedom of movement of the exposures. In a crisis situation, there has to be mobility of the safeguards against these exposures. Okay, so capital liquidity have to be able to move up and down the ladder, the group ladder, from the subs to the center or from the center to the subs, depending where the problem is. So you need internal support agreements within the cross-border groups, which have to be enforceable. This is a legal complication, you have to make it enforceable. And you need, and here I come to the last question, so the deposit insurance. You need a deposit insurance which is mutualized and backstopped, specific for those cross-border banks. Okay, which I think, so the question, of course, you would need to, certain complication, you need to spin off the cross-border banks from the existing deposit insurance structure. So there would be structural changes to be made. I think that one big political obstacle to EDIS would disappear, which is the small local banks would no longer be involved. Most of the political resistance at the moment against EDIS is precisely that. The local banks say we have our own local pool of risks. We don't want to have anything to do with the foreign banks. Maybe take the risks that we cannot control, etc., etc. So leave those out. They are not into the cross-border and integration business. So do something specific for the cross-border banks. And of course, you have to liberalize, but at the same time, on the same path, you have to review the crisis management and prudential framework. So the two things have to go together in order to be safe. I realize this is much more ambitious than the recommendations that have been made around this table or around these chairs. But I think we also have to look a little bit farther out and be more ambitious.
Thank you very much, Ignazio. There is in supervision this term which is called RWA density. Some of you might know this. I think there's also something like idea density. And I think that if you think about the briefness and the succinctness of your interventions and the richness of the ideas, we had a very high idea density. So that is much appreciated. I think we have a little bit of time to interact also here on this panel. Maybe I want to break the ice there. By replying maybe to two of the things that you said, Maria. You asked for some kind of a mechanism for a holistic approach to capital, not just having all these various actors doing their own little thing, and then suddenly you are the receiving end of what they. So as you know, but maybe not all here in the audience, in the high-level task force report. That was adopted in the end also by the Governing Council. There is a very concrete proposal for that, to use what we call the macroprudential forum, which is the Governing Council and the Supervisory Board together. And by the way, and I see Roberto here in the audience, we can, that is a forum that is sufficiently flexible to also invite other authorities, so we could bring everyone who is relevant to that table to actually do just that. So in the end, of course, the various authorities will have to play their mandate, but nothing stand against them coming together in a structural manner, ex ante, to try to see whether we can form a holistic view of what adequate capital could be. And let me also say here, from my perspective, indeed, also I think that the European banking system is well capitalized. Let's not forget that. That's the first reaction to what you said. The second thing is you said something about the guides, and I think there, the very short answer is I think you have a point. So over the years, we have come up with a lot of guides, supervisory expectations, good practices, and by the way, many times on the request of the banks. Not always, but many times on the request of the bank saying, okay, it's all very well, but there is of course something like an equal treatment imperative for you as a public institution. If you do something to one bank, you're also supposed to do it to another bank under the same kind of circumstances. Maybe it would be good if you were to be transparent about that and accountable about it. So why don't you write that down so that we all know? But still, if you go through these guides, I think we have sometimes not been. There's always, good legalese in the very beginning. This is non-binding. Mm-hmm. So it's there formally. But if you go through it, there's language where you think, well, maybe we pushed the limit a little bit too far. Maybe we actually were not as disciplined as we should have been. So we have embarked on quite an exercise where we say, okay, we look at all these guides and we're going to clean them up. Maybe we can retire some of them. Maybe we can retire some parts of it. Maybe we can clean up the language and really live up to what we promised, and that it is non-binding. So they are good practices guides, and you can be a very perfectly well-behaved bank without following any of these good practices because you have found for yourself better practices. Then maybe you qualify for the next version of that guide, so that you can give some even better practices to the community. Now, not only that, because that's still not enough. So you really have a point. Because it's one thing that we clean up these guides. Another thing is then what happens on the ground. So do the supervisors on the ground, in the trenches, in all their hundreds, thousands of interactions with the banks day after day, do they then actually treat them as non-binding, or is it becoming then in the end? So there's also a cultural issue there. So we have embarked also on a parallel cultural change program to make sure that we live up to that. So to these two things I wanted to just highlight. But Ignazio, you had another question.
I don't want to overburden Maria, because my question is also,
Okay.
I was curious when you said in the first group of recommendations that you made in the last round that you want to see more coordination or more dialogue between different supervisory authorities. Let me be simple. I thought there was only one supervisory authority, which is the ECB. Which authorities are not sufficiently coordinated in your view? The nationals and the center, or the SRB, or who?
Yes. Well, we are thinking of having the microprudential supervisor, so the SSM, but maybe for that it's different. The macroprudential, macroprudential, because many times the microprudential supervisor may be toughen specific risk weighted in a model or on the standard.
You meant the macro. You meant the macro.
The micro, the SSM, but at the same time you have the macroprudential authority working also, for instance, on similar. I don't want to really be very specific because I don't want to talk about Spain. I mean, but it's in all the countries we see that both the microprudential supervisor and the macro one, the one in charge of the macroprudential policy, well, they can overlap among them because they touch and decide on similar things or at least things that are very much interconnected. So it really results in an overlapping.
The macro should be with the ECB. I mean, I'm free to say that now. The problem, that's the problem. The macro
Ignazio has the floor.
ECB. This incredible solution that was not the second best, but the last best at the time of having this asymmetric, whereas the ECB can only top up. I mean, that is something that was guaranteed from the beginning not to work, and it hasn't worked.
But maybe there is another point on this matter between the banks or supervisors inside of the banking union and outside of the banking union. Yeah, for example, Nordic banks. I have many conversations with Nordic banks. Some of them have activities in the Eurozone, in Finland. Others activities outside of the Eurozone. And I don't know, but maybe
that was part of the problem at the beginning. Don't forget,
they need to enter in the euro. Yeah, I know the answer.
There was a problem of the UK.
Yeah,
the UK was still there, right? Yeah. So they were the most, most tough in the negotiation. No question. Okay, now I understood.
So the panel, we are very happy with ourselves here, which is good. But I would like to actually see whether there's anyone who would like to join this conversation from the audience. Oh, I see various hands. That's very good. Please go ahead. 1, 2, at least.
Hey, does this work? Does this? Yes, it was.
Maybe please state your name and then.
Yeah, Linda van Goor. Thank you so much for all the wish lists. Apparently, Maria, you really like the Brazilian approach where they don't have macro anymore. They just have monitoring and supervision. They replaced backward-looking reporting by real-time data sharing, enabling forward-looking supervision. But you are in the biggest bucket with Itaú and 3 others, so actually, let's talk about that further. No, we are not dealing with the real problem because we see that member states genuinely love fragmentation. I mean, we know all the advantages of integration. We know all the costs of fragmentation. We know what it would do to competitiveness. We know what we need. We have a plan. But the member states, again and again and again, choose for fragmentation. That cannot be because of knowledge. That must be because of a feeling of fear or something. They feel something that's blocking further integration. And I think Ignazio sort of referred to it, Letta also referred to it. What is it? So my question to you is, what would you say to member states who are afraid of losing something when they open up to an integrated market? When they allow for European champions instead of national champions, when they allow for European infrastructure instead of all those national agents. I mean, maybe it can be a loss of loyal investors into sovereign debt. Maybe it's a loss of jobs in politics. I don't know. What is it? What would you say to member states who hesitate, who are apparently afraid of something?
Thank you very much. I've spent 5.5 years here to try to show that Dutch are not always direct and plain speaking, but you know, you just... Anyway, thank you so much.
I love you, Frank, you know that.
In the back, and we take at least two and then we can see.
Thank you. Marco Triano from Scope Ratings. It's actually a question in a similar vein. I think, you know, we have a lot of diagnosis, 2 reports, Letta mentioned it today, but it's clear that the underlying topic is political willingness and, you know, whether we can move forward. Now, about 15 years ago, a wise man here said to the markets speculating, do not underestimate Europe's political capital. And my question is, do you think maybe today we are overestimating Europe's political capital? And, you know, we're all Europeans in here and in the institutions, we have strong agencies. But is the willingness out there, outside of the institutions, still sufficient? And can this capital be mobilized in peacetime, or do we need to wait for a crisis for things to happen?
Do we need a crisis? Very good.
But we are in a crisis. No?
Jonás, you have the floor.
No, I have nothing to add to the last question. I think that after this panel we have the possibility to listen to our commissioner, and I think that she is in a better position to explain how we should exploit our political capital during this mandate. Yeah, but the point is that maybe we are not seeing correctly that Europe is in a very difficult situation. Yeah, I said at the beginning that our banking system is better than in the past. But maybe we are seeing a crisis in a televised process, or like the fog in the hot water, yeah. And I think that this kind of pseudo crisis or whatever is more difficult to identify by the public, yeah. And I don't know. We are at the beginning of the mandate in any case, and I have at least a high expectation for what our commissioner will put on the table in the future, as she did with the market integration package. And to the first question, member states, I was sitting with the council in many trialogues, yeah, during these years, and I think that there is not any other exercise in the parliament which we would like more than criticize the council, yeah. So we always say all the problems are always in the council. Okay, I have to say that most of them are in the council for sure, but it's not easy. Yeah, during the implementation of in the trialogues of the CRR-CRD, the last Basel implementation in Europe, in the Parliament, the negotiation team introduced, for example, the application of the output floor at consolidated level solo. Yeah, I think that. Not taking into account the banking union, and we try to facilitate the use of the capital and liquidity waivers, yeah, through different articles, yeah, and during the trialogues it was completely impossible, yeah. So we really like to criticize the council. I think that we have good reasons to do that, but we need, I don't know, it's not easy to answer.
Maria?
Yes, a brief comment. I mean, I think that the world has changed so much. So really, Europe needs to react to the current challenges we have. And really, the way forward is to have more Europe. And really, our best asset is the euro. This has really provided with a lot of stability to the whole region. So if we don't join efforts with that specific challenge we have, low growth in Europe, we are not going to really react and make the reforms we need, the investments we need to really maintain our certain economic power in the world we have today.
Thank you for celebrating the euro. I would add soon in digital form in a device near you.
I hope so.
We can.
Britta?
Yeah, I mean, maybe to the first question, I think it's also perhaps worth recognizing that even if we had a banking union, not everyone would necessarily make use of it. We would have perhaps a couple of larger pan-European banks, but it's not like every single deposit in every country will fund lending anywhere else. And I think, similar to Maria's point, if you want cross-border investment, it would be great to have banks that can operate cross-border to go along with that. And then with regards to the other question as to what would really be the impetus, I actually also wrote down crisis. So I think we all agree that a crisis always shifts mindsets. But there are a couple of tendencies where we do see a little bit of, let's say, industrial policy or also protectionism around what are sovereign bonds. I guess if we had an environment where it wasn't retail deposit money that was basically indirectly funding the sovereigns, but where the sovereigns could fund in more private markets and the deposits could be deployed elsewhere, I think that would probably alleviate some of these worries.
Ignazio?
I don't have much to add. I think both questions were sort of political, so it's entirely appropriate that Jonás answer them. My instinct would be, whenever you see an insurmountable obstacle, don't keep on bumping your head against it, try to go around it. And I see, for example, the question of having an omnicomprehensive EDIS, so an EDIS that covers all banks in the whole banking union area, is probably one of those insurmountable obstacles, because there are a number of banks, I'm repeating my argument now, but there are a number of banks which are exclusively local. They have their own arrangements, they have their own risks, they don't want to be involved, and they have nothing to do with whatever we want to implement in terms of integration of the banking system. So leave them alone. That would be my... So that was part of the reason why I came up originally with this idea, okay, select a number of banks that really matter for the goal that you want to achieve. Be pragmatic and try to design an arrangement for those banks. I think that also Politica has a better chance.
No, if I add something on this matter, I will not enter in the debate itself because I'm not in that position to debate now that proposal. But I think that proposal links with the debate around proportionality in some way. Yeah. So, and proportionality, the point is that if, at least for me, proportionality is another debate completely linked with the banking union. If we will be able to advance more in the banking union, I think that the debate around proportionality will be easier. The point is that now, even from a regulatory point of view, in our CRR, there are many requests, ring-fencing, you said before, taking into account the national reality markets. And given that we take the national markets to regulate, it's more difficult to introduce more proportionality because we don't have, from a regulatory point of view, a truly banking union. Yeah. So without entering on your proposal on EDIS, for example, in the definition of small and non-complex entities, there is a reference taking into account the reality in every member state. Yeah. There is not only a definition taking into account the size of the risk of the balances. There are also arguments in the articles to define some banks no significance because in the local market could be irrelevant, even though the same bank in another country with a bigger bank with a bigger market will not be significant. So with EDIS and with other ideas, I think that we need a push in the banking union to consider or to analyze properly what is the current level of proportionality that we need.
Thank you, Jonás. There's actually still time for some more questions. Yes, please. I see two there on my left and one on the right. So that's three. I'll take all three together and then we wrap up after that.
Hello, can you hear me? Okay. I have a question to Mr. Angeloni regarding this proposal about, let's say, different regime for cross-border and large banks and this idea of EU champions, basically. Also in comparison with...
Speak a bit louder if you can.
The idea of the EU champions.
Yes.
Also in comparison with the US banks. Would this idea, let's say, mean also a split between investment banks and, let's say, retail banks, so that these cross-border banks and the regulation and the mobility of capital would only apply to investment banks, also financing a large corporation while leaving, let's say, retail banking to domestic markets, also in order to ensure a sort of level playing field between these large banks and small banks within the EU?
Very clear question. Let's collect quickly the other ones.
Thank you, Ilya Lingorski, Bulgarian National Bank. Following on the previous question towards Ignazio, but also Maria, if the Americans go on a deregulatory spree over the next couple of years, and given everything Mickey Bowman is saying, as well as what we hear from the top 10 CEOs before Senate committee with regard to Basel III and capital and buffer and all other requirements, what should be the response with regard to creating these cross-border champions from, on European soil, given the fact that the level playing field may be slightly tilted if the Americans really decide to go on a very ambitious deregulatory tour?
Very important question. I saw one, Malte, please, and then we take him here.
Thanks a lot. Yeah, I can be quick because it follows directly on the first question also to Ignazio. It's essentially, if you have a pure cross-border EDIS, aren't you concerned that essentially you would take out the most diversified institutions and you sort of leave behind a set of less diversified, smaller set essentially, from insurance logic, so to speak, that you're kind of like cream skinning and, you effectively not enhance depositor protection across the euro area, which was the initial goal, but you may even weaken it if you have the sort of two-tier system.
Yeah, understood. Let me start with the last one. I don't think you would have a less diversified. You would eliminate certain components. You would have to spin off. I think those large banks would be by nature, by construction, diversified geographically at least, not only Europe and euro area, but also globally. So diversification would be there. You would have a smaller pool, no question. And you would have a problem of spinning off those big components from the existing. But I think in terms of diversification, I don't think you would have that problem. I don't think you would have that problem in terms of diversification. Would have to be studied. It would have to be studied. So one would have to make very good calculations of what would be the subset of banks that can participate to this restricted club, so to speak. What are their exposures? What are the stakes that they already have in the existing deposit insurance schemes, and how would they be transferred? So it requires a lot of calculations that I didn't do, but could be done. The information exists and could be done. So that would have to be studied in depth. The first question was, shouldn't we, if I understood correctly, separate still, the old Glass-Steagall idea that was in the end was abandoned, to separate commercial banking from investment banking. I'm not a friend of that idea. I understand that there are risks from the intermingling of the two, but there are also complementarities because the investment banking part requires a pool of liquidity, which the commercial banking part provides. And so one has to find and there's no coincidence why at the end of the last century that system was abandoned. And that was the beginning of sort of the big banks, the big US banks, which I think all in all successful, with problems, but successful. That comes from there. So I have not much sympathy with that. I think it's not very realistic, particularly in the modern world, in which it's very difficult to have regulation that segment different lines of business. The second question was the most complicated. I mean, I will be curious what Frank has to say about that. If the Americans go a certain way, should we follow? Or to what extent should we follow? Because I don't think we can completely ignore. I mean, we have to compete with these guys. So I think to some extent, we need to be flexible in that respect. That's my own personal view. But to make a good compromise. Frank, please help me on this because you know much more.
I'm looking at the clock and we have 1 more minute. But I will...
very prudent supervisor.
So Maria, why don't I give you that 1 minute to you and then I will wrap up and I will promise that in that wrap up I will say something on this.
Yes, well, I just wanted to react by saying that we are not asking less capital for European banks, but of course, competitiveness is a dynamic concept. So, you can see that the UK has already presented the idea of reducing the capital benchmark for their system. The US also has presented different reforms, and it results in an overall decrease of capitals for the largest banks. So, what we want is stability in capital. So we will be happy if capital stop increasing, especially without, specific mention. And of course, I think that Europe should take a look of what other countries are doing because we need to preserve this level playing field.
Thank you so much. As promised, I want to stick more or less in time. So I'm going to wrap up and I'll do that fast. I want to thank all of you for what I thought is a very lively and rich debate. I want to thank all of you for contributing and for paying close attention. A couple of things that I heard. I heard you, Ignazio, giving 2 thumbs up for the last 10 years on supervision. That is a great thing to hear. Thank you for saying that. And I really hope that 10 years from now, looking back, we can say the same. For what we have achieved back then. I heard the chair of the EBF Executive Committee not once but twice say that the banks do not need, literally, you said that, reducing capital twice. I heard you say that. But it is also true, and I have to be fair, that you said, but we want more proportionality, we want simplification. And actually, I think that on these things we can shake hands. I heard Ignazio giving us a very clear advice that we shouldn't be head-banging on the biggest problems, but we should try to slice and dice them and to maybe walk around. I heard Britta and others talk about the need for scale. We talked about cross-border banking integration. I promised I would say something on what do you do if, of course, international banking is by definition served well by a international level playing field, and if that playing field were to no longer be level. Now, first of all, some of these things that one of the distinguished the colleagues in the audience referred to is still hypothetical. We have to see how things will go. But of course, this is a very valid question. What do you do if in the end you want to achieve something with other jurisdictions, but they don't play ball if they were not to play ball? Now, for example, so I don't want to just be so very, very high over. On the FRTB, you know that we have been very clear in our support for the Commission proposal to have, I think, a very nuanced way of doing things. We could have said, as a supervisor, remember there's Basel, and we just want everything to be implemented in time and fully and without any flexibility. I think there we have been. The Governing Council has issued an opinion clearly throwing the way that we have behind the European Commission's approach, which is something less than just implementing, but seeing also what other jurisdictions do. So there is something to be said for of course being very much aware of what happens in the world. But on the other hand, it is also true that if there were to be a real race to the bottom, there comes a point that one has to think at the bottom we all drown, and we also don't want that. So finding the right balance there is very complicated and is something very difficult to comment on in a more hypothetical sense. That's why I mentioned the FRTB as an example where I think that nuanced approach has been found and where also we as a supervisor and as the European Central Bank have shown that we can understand that. Now we have, I have good news for you and bad news. The bad news is there is no coffee break, no tea break, but the very good news is that you will get instead something much better, which is the Commissioner. Thank you so much.